Thank you for joining us for our mid-year outlook. My name is Chris Curlow, Chief Investment Officer at Team LWC. 2025 has been marked with volatility, headline risks, and a lot of things we didn't expect to happen did happen. Donald Trump obviously took center stage with his tariff rhetoric, marked by the low on Liberation Day in mid-April. That volatility gave us a lot of opportunity. It was the most active time in my tenure here at Canaccord Genuity from a trading perspective, moving in and out of securities and buying on dips. That paid dividend as we ended the first half higher than we started, despite a rocky road to get there. With all that said, we're still cautiously optimistic going into the second half of 2025. We think that markets, despite having zero equity risk premium, which is essentially the risk you're taking for being in equities versus risk-free treasuries, historically that level's at about 300 basis points. There's two ways that we get there. One is with lower bond yields. The second is with multiple compression. That's how much someone's willing to pay for $1 of earnings in the S&P 500. For that fact, we're actually seeing more opportunity, as we did at the start of the year, in international equities. We've been heavily overweight that sector, and it's paid off as the international sphere has outperformed the domestic equities, as well as Canada outperforming the United States, which is the first time in quite some time from an equity standpoint. How we get there is we believe that a lot of the earnings revisions that were taken back during the challenging tariff times in the market get re-released, and an outlook for the back half of the year is priced in. Secondly, we think that the monetary policy, which has been on pause by the central bank in the United States and more recently here in Canada, picks back up as inflation expectations are brought down, which is a non-consensus view. The reason we see that is the CPI is made up of two components: consumer goods and consumer services, in about a 40-60 mix. For the past little while, the services sector of CPI has been relatively deflationary. Things like hotels, airlines, flights aren't really rising in price, and in some places coming down. The other aspect is the 40%, the goods sector. A, not all those goods are imported and subject to tariffs, but B, the consumer's much different now than they were in the COVID era, meaning that they have less ability to take those price hikes. So we don't think that companies will be easily able to pass through a lot of that into consumer prices and raise inflation. Inflation is the threat to bonds and bond yields, and so for that reason we can actually see bond yields being able to drift lower in the back half of the year. That's good for longer duration assets. You could think of things such as real estate, pipelines, utilities. We've been heavily weighted in the pipelines and utilities, and that's paid dividends in the first half of the year. And we more recently added to our global real estate exposure with an actively managed fund with a covered call overlay. Complicated sentence, but what that means is we're writing calls and generating income on top of just the capital appreciation of the underlying stocks. The REIT sector in general has yet to recover alongside the market since the 2022 sell-off, which was caused by this rise in yields and expansion of cap rates, basically how you value real estate. We think that because it's still at those low valuations, we have a margin of safety from it going even lower, but also some upside to where when those bond yields come down, the asset class expands, and in the meantime, we're getting paid more than 9% to hold this security. That was one of our changes this year. The other is our continued faith and belief on the international sector. We continue to maintain an overweight and have leaned into that trade, adding more dollars to the international equities in our client portfolios, as well as emerging markets. Aiding that trade has been the devaluation of the US dollar. In the first half of 2025, we saw the US dollar fall more than 10% against the trade-weighted basket of currencies. We got about half of that here for the loonie. That's great for my fellow snowbirds. As we move into the back half of 2025, we think that the path of least resistance is lower for the dollar, which would be good for international earnings, as well as Canadian dollar earnings, as well as US companies that sell their products abroad. What it's also good for is commodities. All commodities in the world, gold, energy, oil, uranium, all priced in US dollars. So a lower dollar could mean a higher commodity price. We saw that front and center with gold. Gold hit all-time highs in the first half of 2025, and we're expecting that it could even creep higher after a little bit of a pause and sideways momentum for the last 2 months, meaning May and June. We also are overweight the gold sector because of the backing of a lot of central banks not buying US treasuries as much anymore and leaning into buying more physical gold. There's only so much in the world, and that's helped bid up the commodity price. And the companies really haven't followed suit. So we believe that there's a great opportunity still in the gold miners, and we have exposure to that through Agnico Eagle in our Canadian dividend model, as well as the Dynamic Precious Metals Fund, which is held in most of our clients' model accounts. We recently trimmed our energy exposure on the traditional hydrocarbon oil and gas plays and put that reduced exposure into a further overweight on the gold side. Reason being, we aren't setting up for quite as strong or optimistic outlook for energy in the back half of the year. OPEC continues to increase supply. In the big beautiful bill recently released by the US, they didn't provide quite as much funds for Donald Trump to fill it up with the special, with the SPR, and that was one of the catalysts we were hoping to see support the price in the back half of the year, as well as the tariff wars are continuing, more recently with some tariffs announced here on Canada just today. That has us a little bit cautious on the sector. We still remain market weight to slightly overweight in positions that a lot of you would own, such as CNQ, TC Energy, Enbridge, and the Canoe Energy and Income Fund. But we're going to remain steadfast at that slight overweight and would be buyers on weakness, as we see that the energy transition is a bit overblown, going to take time, but there's still that huge need to solve our energy pending crisis because of the growing global population and lack of traditional energy to keep up. For that reason, we're most bullish on the uranium sector, recently adding a uranium company, UEC, which will be the largest uranium producer in the United States, quintupling their production over the course of the next several years. With all that, a lot to take on, a lot to take in. We're here all the time to answer your questions. Thank you for your trust, and we look forward to continuing to work with you. Thank you.